Good morning and welcome to Financial Accounting. Today is day 3 and we'll be continuing our work on Chapter 1. So you should have your Chapter 1 exercises open in See Now. We'll be working on those very shortly. I always like to start class with a reminder of where we are and give you just a look ahead to keep everybody on the same page. So as I said, today we should be finishing up the Chapter 1 exercises. And that means that the Chapter 1 problem would be due on Thursday in See Now. Also on Thursday, because we'll be starting Chapter 2, then the Chapter 2 pre-quiz would be due, and you need to get a 60% or higher on that to get full credit. And finally, on Thursday, if you have not already selected a company for your Take It Further Real World Annual Report project for this semester, please make sure you post your company name to the discussion board in Brightspace. I do hope to get through those before the end of this week. So that would mean starting with whoever has already posted and hopefully being able to finish those up on Friday morning. So if you haven't posted a company at that point, because I will be gone next week, I likely will just assign you a company if you haven't chosen one, because I don't want to wait until the week I'm back to start assigning those companies. So I want to make sure everybody has one, because our first exam is coming up. I know it's only the second week of class, but we have 5 exams. So that means, basically every 3 weeks we're having an exam. Any questions about that? So what's due in the next couple days here? Okay. On Thursday, then we'll talk a little bit more about what's going to happen in my absence next week, but do keep in mind that you will not have actual class on the 2 days next week. So you will have work to do. It will be just like a regular class, except maybe you don't have to get up as early and come over to the classroom. But on Thursday, I will explain what you need to do. So next, let's talk a little bit of review from last class. Again, if you have questions, please just stop me. You don't need to wait for me to ask if you have questions. So last class, we talked about the different types of business organization. We know we're focusing on the corporate form of organization this semester. We're looking specifically at publicly traded companies, because they have to follow the generally accepted accounting principles, or GAAP, and that's what we're learning. The company that you choose for your project then is going to be using those same principles that we are learning in this class to prepare their financial statements, and that's why throughout this semester you'll be looking at their annual report to see how what you're learning in this class applies in the real world. So it is that applied learning piece. We know that there are also 3 different basic ways of doing business. You can be providing a service, selling a product that someone else makes, or selling a product that you make. And our focus for this semester is on companies that sell a product that someone else has already made. We call those merchandising operations or retail operations. Finally, we talked about the 4 basic financial statements. And again, throughout this semester, we're going to be learning how to make these statements, and also how to use the information on those statements. Because as I told you last class, the whole purpose of accounting, from my view, is to help decision makers make some decision about our company. And so we need to give them, those decision makers, whether they're inside or outside of the company, we need to give them the information they need in a way that's relevant and reliable and useful, so that they can make an appropriate decision with the information we provided. I did ask you on Thursday of last week to make sure that you read through the extra terminology in the textbook about the characteristics, qualitative characteristics, and specifically of accounting financial statements. And so if you do have any questions about those terms, please make sure you ask. But I don't plan to read you the definitions out of the textbook of the characteristics that make up the financial statements. So the 4 financial statements that all publicly traded companies are going to include in their annual report as the foundation or the basis of that report, along with any notes and other explanation that goes along with those. The 4 financial statements we're going to just briefly review here. And you can see the first 2 on the screen right now. The first one is the income statement. That's the first one that is prepared. It is a summary of all of the revenues. So basically, revenues are the amounts that we charge our customers for the product or service that we are providing to them. And then we subtract from those revenues all of the costs of generating those revenues, and we call those expenses. And so you can see on the screen that in this case for Net Solutions, that their revenues were $7,500 and their expenses for that same period were, just rounding off, about $4,500. And so that left them with an income, or what you might call a profit, of about $3,000. So that means that they improved their financial situation by about $3,000 during this time period. You'll notice that each one of the financial statements has a 3-line heading. So the name of the company is the first line. The name of the financial statement or report that you are preparing is the second line. And then the third line is either the date of the statement or the range of dates that it covers. So most of our financial statements talk about what happened over a range of dates. So this one you can see says for the month ended. It's important that we know it was the month, not the week or the quarter or the day or the whole year. We need to know the time period that is covered. How long did it take them to earn this $3,000? The income statement is prepared first, I said, and you can see why if you look at the flow of arrows on this chart, that the second financial statement that we prepare, which is the statement of stockholders' equity, uses that net income, or if the company doesn't make money, if their expenses actually exceed or are higher than their revenues, then they would lose money. And so they would have a net loss. But that net income or net loss on their income statement then moves forward and is included on the statement of stockholders' equity. That is added to their retained earnings, and it increases their total equity in the company. So the statement of stockholders' equity for most of this semester until we get to chapter 12, it's really only going to have 2 individual columns and then the total. The 2 columns are the common stock, which is the only stock account we'll be looking at until chapter 12, which is all about stockholders' equity. And then we'll learn a little bit more to include here. The common stock represents the contributed capital. And what that means is that's the amount that the shareholders paid when they first bought those shares. So again, we'll talk about this more in chapter 12, but most stock transactions that you think, that you hear about, if you hear about the number of the trading volume, it's called the number of shares that are traded on a given day in a given stock on the open market. Most of those are what we call secondary transactions that are occurring between a current stockholder and a future stockholder. So someone who owns the stock sells it to someone who wants to buy it. That doesn't affect the company at all. That's its secondary market. The company's financial statements are not affected by that in any way. So the contributed capital, or the common stock, represents what's called a primary transaction, when the company sold that stock to the stockholders when it first was sold. That's contributed capital and common stock. As I said, until chapter 12, common stock's the only contributed capital account we will have. And then the second column there is called retained earnings, and that represents all of the company, all the money, all of the income that the company has made since the company started, minus any dividends that were paid out. And so the statement of stockholders' equity starts with the beginning balances. Now we can tell that this was a brand new company, that it didn't exist before the month of November, because you can see that the beginning balances here get my spotlight here so you can see, whoops, there we go. So you can see better. The beginning balances here on this line are all zeros. They didn't have any common stock outstanding before November started. They didn't have any retained earnings because it was a brand new company. And so you can see that during the year they sold some stock and that they made, or during the month, excuse me, they sold some stock, they made some money, but they also paid out some dividends. So they went from zero equity at the beginning of the month to about $26,000 worth of equity at the end of the month. Now on Thursday of last week, we talked about the fundamental accounting equation, assets equals liabilities plus equity. So we know at the end of the month, they had $26,000 in equity. We don't know what their assets are yet. We'll see that on the next slide. But we know that whatever their liabilities are, when we add it to this $26,000 in equity, that must be equal to the total assets. And so as we go ahead then to the final two financial statements, the third one we prepare is the balance sheet. And again, you can see why we needed to prepare the equity statement first, because the balances from that equity statement flow forward, move ahead from the equity statement onto the balance sheet. And we can see those numbers right here. I know they're hard to see, they're a little small on that screen, but these are the same numbers that were the ending balances from the statement of stockholders' equity. And we can see that the total assets right here are equal to the total liabilities plus equity. That's why it's called a balance sheet, because it has to balance or be equal on both sides. Let me say one more thing about the balance sheet. So you'll notice this line right here on the balance sheet is a single date. So the balance sheet is the only one of the four financial statements that is what I think of as a snapshot. You took a picture of where are we at this moment in time. It doesn't show us what happened over some period of time, unlike the income statement, the statement of stockholders' equity. And then the third one is the next one is the cash flow statement, and it also covers some period of time. So the balance sheet is the only one that the date line is just a single date. The others are all need to specify what time period, day, month, quarter, year, whatever. Okay, so that is my not so brief review of the very important information that we covered last class. Does anyone have any questions about any of that at this point? All righty. So let's, at this point, get this dumb thing out of my way. So let's go to our first exercise for today. And hopefully everyone or almost everyone has access. I've sent a couple emails to people this morning saying, please try to log in and let me know what happens. Cengage has been working on a couple things on the back end, trying to get things fixed for people. So if you were working with me in any way about getting access, please just try to log in and see what happens. And touch base with me later or send me an email if you're still having access issues. So our first exercise for today, again, as I said before I started the recording today, exercises 1, 7, and 9, I asked you already to do on your own. We did exercise 2 together, and so now we're on exercise 3. Indicate whether each of the following is identified with an asset, a liability, or stockholders' equity. So we defined all of these terms last class, but I need to add something else to this. So let me just write out for you on the screen our fundamental accounting equation to remind us. Assets are things that we own or control that are going to be beneficial, helpful for the company in the future, helping us to make money. Liabilities represent amounts that we owe to someone outside of the company. And then we have our stockholders' equity. But I want to expand that stockholders' equity a little bit more. So we've already talked about the two main parts, common stock and retained earnings. But again, I want to expand on that even a little bit more. So common stock, I'm just going to leave that alone. Common stock or contributed capital. We know that that represents the investments made by the stockholders, but it's this retained earnings piece that I want to expand on a little bit. Retained earnings, we already saw, we just saw in our review that retained earnings appears on the balance sheet. But if you think back to the first financial statements we saw, as we just reviewed, we had the income statement, which calculated for us net income or net loss. And then I pointed out to you that that number, in our example, it was $3,050. That number then gets added to our retained earnings. So what went into that number? Our revenues and our expenses. So we know that revenues and expenses are related to retained earnings, that we add those to retained earnings on the statement of stockholders' equity. So I'm going to include those. Basically we added revenues and we subtracted expenses because that part is our net income, right? Revenues minus expenses is net income, and we added that to our retained earnings. There was something else on the statement of stockholders' equity that we subtracted from our equity to find the ending balance. In addition to the income, there was one other piece that we subtracted. Does anyone remember what that was? I did point it out, but I said it just very briefly, so it's okay if you don't remember. I will tell you. It was dividends. And I pointed out to you that the company had paid some dividends. So they made $3,050, but $2,000 of that they didn't keep, they didn't retain. So it was earnings, but it was not retained earnings because they paid it out to their shareholders. Dividends are one way that you earn a return on your investment. When you buy stock in a company, the company may pay dividends, and that's one way you get a return. Again, we'll talk about that more when we get to chapter 12 on stockholders' equity. So these three types of accounts that we see right here that I just boxed in, it's red on my screen. It doesn't look very red to me up there. Revenues, expenses, and dividends really all are part of stockholders' equity because they become or they affect retained earnings. We have a special name for these accounts. Revenues, expenses, and dividends are known as temporary or nominal accounts. And that distinction will be more important for us when we get to chapters 3 and 4. Temporary or nominal accounts. These other accounts that I'm going to box over here, these accounts are known as the permanent or real accounts. So the accounts that show up on the balance sheet, assets, liabilities, contributed capital, and retained earnings are called permanent accounts or real accounts. And the others, revenues, expenses, and dividends, are called temporary or nominal accounts. And what that means is at the end of each accounting period, those temporary accounts get zeroed out. And we will see in a couple of weeks how that happens, how we do that, how we accomplish that in our accounting records. But for now, it's enough for us to know that first, those temporary or nominal accounts are really part of stockholders' equity. They're really part of retained earnings. but they don't carry their balance forward. And the reason I'm talking about this right now is it's going to be a question for us when we get to this exercise, which we're going to do right now. So we need to recognize that those other three terms are all part of stockholders' equity. And so as we look at the 6 terms that are here, all of these represent a account title. And we'll get into that more in chapter 2. Each one of these 6 terms represents an account title. And we're asked to identify whether it's an asset, a liability, or an equity account. And so with what I just told you, any account that says expense, like we see here, supplies expense, utilities expense, we know that those expense accounts are going to be equity accounts. An expense account almost always, and if I had my way, it would be every single time. An expense account should always include the word expense. You'll hear me say this more than once throughout the semester. I really don't like when they use the word fees because it's not clear in that word whether a fee is something you paid or something you charged your customer. And so I don't really care for that term. The fees earned tells me at least, oh, this is something we charged our customer. We earned that by providing some product or service to our customer. And so the fees earned is a revenue account. And so for that reason, it's part of stockholders' equity. Again, most revenue accounts include the word revenue in there and makes it very clear what we're talking about. But fees earned is one that, I don't know, they like to use in this book. Let's look at the others, because as you'll see, we keep running into the same account titles because the accounts that we use for the most part are accounts that most companies use. Account titles that you will see over and over throughout this course and in the real world if you're looking at accounting information. It is not possible for us in this class to discuss every single possible account that you might see ever in your entire life in any business setting, because many companies have accounts that are exclusive really to their use. You know, they tailor the account titles, the types of accounts that they use to how they do business. So we can't possibly talk about all of them. But my goal is if we talk about the explanation enough in broad enough terms that when you see an account title that you've never seen before, you can figure out what type of account that might be just based on the title. And we're going to see that. I just told you that most expense accounts include the word expense. Most revenue accounts include the word revenue. These first two here, A and B, also include words that are significant to us. So this first letter A, accounts payable. Payable means we owe someone and we will pay them later. So what type of account is that? If we owe someone and we're going to pay them later, that's a liability. Receivable is really the exact opposite of a payable. Receivable means someone owes us and they will pay, we hope, they will pay us later. Now we have a whole chapter about the middle of the semester about receivables. And so we'll really be getting into that, about March, but not March, let me word it's just fall semester, about October sometime. But receivable means someone owes us. And that means that a receivable is, an asset. It's going to help us because eventually whoever owes us is going to pay us, we hope, and then we'll have the cash and we can use that cash to run our business. The last one here then for this exercise is supplies. Now you'll notice right underneath that they have a supplies expense. That represents the cost or the value of the supplies that we used up in the running of our business. The supplies account in letter D represents the value of the supplies that we still have, that we can use in the future to run our business. And that's why it is an asset. Okay, any questions about that exercise? You've seen already at the end of the exercise, you're welcome to click the check my work button. You don't need to, but you are welcome to, and then you can see your grade on the assignment going up at the bottom, so you can keep track of that. You know, yours should say more than 10% because we did at least one exercise together, and maybe you've already done some of the independent ones. I don't know if I said last week, but I am not able to save any of my work because I'm just previewing it as a student. And so my assignment score always starts from 0 at the beginning of each class, but yours should reflect the work that we already did last class and any that you've done already outside of class. And let's move on to exercise 4. So any questions? Any questions so far? Okay. So we're going to get into actually talking about transactions, and our focus in chapter 2 is going to be transaction analysis. How do we record this stuff in our accounting records? How do we get it into our system? But for now, we're just starting to think about when transactions happen, how do they affect our financial position? What kind of changes do we see in those accounts, assets, liabilities, and equity accounts? So we said last class, I had talked about what a transaction is. I said a transaction is something that affects the financial position of our company and therefore needs to be recorded so that our records reflect that change in our financial position. I also know that I said not everything that happens in a company is a transaction. Not everything needs to be recorded. So for example, if we're trying to hire somebody tomorrow, we have an interview. The business faculty have an interview with someone who is interested in the accounting faculty position. And that's important. That's really important for us, but it's not a transaction because we aren't making any kind of a financial commitment. We're not even making a job offer, and the job offer wouldn't even represent a transaction. So, doing interviews is important. It's really important to the running of any business, but it's not a transaction and doesn't need to be recorded. So the first question you have to ask yourself when you read about or learn about something that happened, the first question is this a transaction at all? That is, does it change or affect our financial position? So our financial position really is that balance sheet statement. Assets equals liabilities plus equity. Sometimes, in fact, the balance sheet is referred to as the statement of financial position. In this class, we will call it the balance sheet. But when you look at the balance sheet for the company that you choose for your project, you may see that they don't call it the balance sheet at all. It may be called the statement of financial position or something similar to that. Let's look at exercise A, or part A of this exercise. It says, a vacant lot acquired for $115,000 is sold for $298,000 in cash. So they already own the vacant lot, and the historical cost, or what they paid for it originally, was $115,000. What that means is it's on our balance sheet already valued at $115,000. Now, I know I talked last week about that historical cost principle, that we record things at what we paid for them. And in chapter 9, I know I keep referencing chapters that are in the future, but I'm just trying to help you see how what we do today will be affected and added to, expanded on by what we do over the course of the next 14 weeks. So in chapter 9, we'll be talking about where did that $115,000 come from? What's included in that? But again, for today, it's enough for us to know we recorded it at $115,000. That land is an asset for us, right? It's an asset. But we sold it, and we sold it for about $300,000 in cash. So let's think about how our accounting equation would be changed. Can we agree that this was a transaction, that something changed in our financial position here? Okay, so that's the first step. Did something change? And I think definitely that's clear that yes, something changed. So what's going to happen to our total assets? Are they going to go up, go down, or remain unchanged? They're going to go up. I heard a couple different people say it or signal somehow. They're going to increase. But how much are they increasing? We already had some land worth $115,000. And where did you get that from, Nicole? Okay, perfect. So $183,000 is the actual change. So we had land worth $115,000, but we don't have that anymore. So that would come off our balance sheet. So our land goes down by $115,000, but at the same time, our cash goes up by $298,000. So the net change is the $183,000 increase in our assets. Everyone okay with that? Okay. How about our liabilities? Did anything change in our liabilities? No. No change. So I'm just going to put a 0 in over here. No change. Now we know the fundamental accounting equation. Assets on one hand, liabilities and equity on the other hand. We know assets went up by $183,000, and we also know liabilities didn't change. So what must have happened to our equity to keep this equation in balance? We must have had an increase of exactly the same amount as our assets went up. Everybody good with that? Okay. How about the second part? So in the second part, it tells us that the seller owed $80,000 on that land. Good. Are you here for accounting? Are you here for accounting? Stats? Yes. That one. So okay. Yeah, your classroom, we switched classrooms. Okay. So thank you. Yeah. That's why it feels like to you, you walked in the middle of class, because this class starts at 10:15. Okay, sorry. No worries. So, everybody good so far? So they own the $115,000, but they owe $80,000. And so after they sold the land, they have to take, because they don't have the land anymore, they can't still have basically a mortgage on that land or a loan against that land. And so they take $80,000 worth of the cash that they got from the sale and they pay off the loan. So we already recorded what happened in part A. Now we're looking at only the payoff of the loan. We already recorded the sale of the land, so we're only considering the payoff of the loan. What happens to our assets? Our assets decrease because we used cash to pay off the loan. So cash is going to go down, and our total assets are also going to go down by the amount of cash that we used. We used $80,000 in cash, our assets go down by $80,000. How about liabilities? So we had the loan, we had a liability for $80,000, but we just paid it off. So our liabilities will also go down by $80,000. And again, because we know that assets must be equal to liabilities and equity, if our assets and liabilities both changed by the same amount, it must be true that our equity stays the same. So think carefully about this last question. Is it true that a transaction always affects at least two elements, that is assets, liabilities, or equity? Must every transaction involve at least two of those? No. So take as an example, let's say this company now decides they want to buy another piece of land. They have all that excess cash from the sale of the first vacant lot. And so maybe they take $100,000 and they go buy another vacant lot. I don't know why, but let's just assume that it's in their business interest. And so they take $100,000 in cash. Cash goes down by $100,000, but the land goes up by $100,000. So one asset went up, one asset went down. No equity or liabilities, so only one element was affected by that transaction I just described. To take this one step further, and if you like to do so, please go ahead and hit the check my work button. We're done with this exercise. But what you should have noticed there is every transaction affects at least two accounts, but they don't have to be two different types of accounts. So it can be two assets. It could be two liabilities. It could be two equity accounts. Let's keep moving. Any questions before we keep going? So again, this is really getting us ready for, in chapter 2, starting to record transactions. Because the first step, as I already described, the first step is it a transaction? Yes. If the answer is yes, we know we need to record it. And so now we're thinking about what would we need to record. Yes. That's correct. Yep. Cash is an asset. So, and I think maybe to keep those separate, to maybe sort it out in your head, assets are things that the company owns. Equity represents the owners of the company, their stake in those assets. So you wouldn't list anything specific like cash, building, equipment, or anything like that as equity, because those are all representing things the company owns. So remember last class we talked about separate entity, that here's the business, here are the customers, the employees, the suppliers, government, any other agencies are all outside the business. And so in our financial statements, we only want to look at what affects the business. So the assets are owned by the business and the owners have a stake in that business, but not in any individual thing like cash or equipment or whatever. Makes sense? So I know for a lot of people, these are brand new terms and things, maybe you haven't thought about. They said the first day of class, I don't assume you know anything about accounting or even really about business, but the more you hear them and ask questions and think about it, the more sense it will make in your head. So in this exercise, in our next exercise, we have listed a bunch of transactions. There are 10 in total transactions. And for each of them, we're going to do the same kind of process that we did in the previous exercise. Think about, okay, when this happens, is it a transaction? How does it affect the three components of that fundamental accounting equation, or the three elements? Number 1 says we received cash in exchange for common stock. In other words, we sold some stock in our company. The stockholders now have $50,000 worth of stock, and the business has $50,000 in cash. So what's affected? Cash went up by $50,000. And our equity, the contributed capital, also went up by $50,000. So we're looking for a choice that says increase in an asset, increase in stockholders' equity, and that would be letter C. Everyone okay with that? Make sense? So now, yes. Right. Yep. So in number 2, we purchased supplies for cash. So what do we have now that we didn't have before? Supplies. And what do we no longer have? Cash. So supplies went up and cash went down. Both of those are assets. Yeah, both of those are assets. So we're looking for increase in one asset and decrease in another, and that would be letter A. Number 3, we paid rent for July. So we spent $4,500. We used $4,500 of cash. Cash, you'll notice, comes up a lot. Cash, the cash account gets used more than any other account. And so we paid our rent, we used cash, so one asset went down. Okay, how about the rent part of that? Rent is an expense. It's a cost that we incurred to help us generate revenues. I don't know if this is rent on the store that we use or on some equipment we use or whatever, but rent is an expense, which we know is a stockholder's equity account, right? So our cash went down. We have decrease in an asset. So we know we're looking at D or E. It's always good to use process of elimination rather than looking at all 5 all at once. We know that cash went down, so we're looking at D or E. So then the question is, which of these other 2? Because we recorded the rent expense for July and we recorded it in July, that's going to decrease our revenue, decrease our retained earnings, decrease our income for that month. It decreases our equity. It increased expense, but if you remember at the beginning of class when I wrote out what I called the expanded accounting equation, it said minus expenses. We're subtracting. Are you here for stats? Yeah, you're next door. Yeah, you're going to be over there the whole semester. Okay, any questions on that? Is this making sense? Number 4, we paid advertising expense. Well, that's the same thing. From the standpoint of this exercise, that's the same thing as number 3. We used cash, so our asset went down. We incurred more expense, so our income and our retained earnings and then our equity goes down. So that's also going to be letter E. How about number 5? Received cash for providing delivery services. We charged our customers $11,500. That's revenue, how much we charged our customers. That increases our income, increases our equity. So again, we know we're looking for an increase in stockholders' equity. Well, what's the other part? Received cash. So that's an increase in an asset. That would be letter C. Take just a minute or 2 here and try, without misusing the check my work button, just read through the remaining 5. Try those on your own. Once you give it a legitimate effort, you can use the check my work button. And then I'll very quickly go through those after you've had a minute to try them on your own. I know you guys are a lot younger than I am, and therefore most of you probably have much better eyes than I have, but I see some people are working with very small writing on the screen. If the writing is too small for you, I'm just going to tell you this, and if you're thinking, yeah, who doesn't know that? Great, but there may be someone in here who doesn't know that. Know this. If you hold down on the control key and then spin the wheel in the center of your mouse, it will make the text larger or smaller for you. So if you're looking at the screen thinking, wow, that's just way too small, you can make it bigger. So let's look at number 6. Anyone just want another minute to think about them on your own? Or are we okay to come back together? Assume that means we're good. So number 6, we build customers for delivery services on account. So that means they haven't paid us yet, but that billing on account is what creates that accounts receivable. So we saw that account title, accounts receivable, in one of our earlier exercises already today. Accounts receivable means someone owes us because we provided them a service or sold them a product and they agreed to pay at a later date, terms that we agreed to. So we don't have the cash, unlike the last number 5, but we do have a promise to pay, and that's an account receivable, that's an asset. Our asset has gone up. And at the same time, our revenues went up. We provided them with delivery services and we're charging them $33,970. So our asset goes up and the equity goes up. The revenue goes up, the income goes up, the equity goes up. So that's letter C. So even though cash didn't go up yet, it is another type of asset, accounts receivable. Excuse me. Number 7, we paid creditors on account. How did we pay them? We used cash. Cash is an asset, it goes down. So we're looking for a decrease in an asset. We paid them on account. So we had an accounts payable that we have now reduced or paid off, at least in part. And so our liabilities go down. So that would be letter D. Decrease in an asset, cash, decrease in a liability, accounts payable. Letter D. Number 8, received cash from customers on account. So we already had an accounts receivable. This might be part of the billings that we sent out in number 6. And now some of those customers are paying us. So our accounts receivable goes down because they don't owe us anymore. They just paid their bill, but our cash goes up by the same amount. So that would be letter A, increase in one asset, cash, and decrease in another asset, which is, in this case, accounts receivable. Number 9, determine that the cost of supplies on hand was $300 and $1,500 of supplies had been used during the month. So we'll talk about this exact situation more in chapter 3, so in a couple weeks. But what this means is our balance sheet shows we have those supplies, but it turns out we've used them. We used them up. So we need to get them off our balance sheet. We don't have them anymore. So we're going to reduce our supplies account, reducing the asset supplies. And at the same time, we need to record that we used those up. $1,500 in supplies expense. When our expense goes up, our income goes down, our retained earnings goes down, our equity goes down. So in this case, we're seeing a decrease in an asset, supplies, and a decrease in stockholders' equity because we reported that supplies expense, and that is letter E. And finally, for this exercise, we paid cash dividends. So we used cash, an asset goes down, and we've already mentioned a couple times today that dividends reduce stockholders' equity. It reduces retained earnings because that represents earnings that we did not retain. We paid those out. And so again, that would be letter E. Cash goes down, equity goes down. This is a very nice example of what I was trying to explain to you last week, that usually after you click that check my work button, you get a nice feedback box like this that gives you some hints. So if we did miss anything, usually looking at these gray boxes is going to give you some helpful hints about how to fix what you may have gotten wrong. Okay, moving on then to exercise 6. Everybody good so far? Questions, anybody? Exercise 6. 4 different corporations, Amber, Blue, Coral, and Daffodil, show the same balance sheet data at the beginning and end of the year. These data, exclusive of the amount of stockholders' equity, are summarized as follows. So before I keep reading, if we know the assets and we know the liabilities, can we find the stockholders' equity? Yes. So I'd like to ask you to do that. Go ahead and find the stockholders' equity, and I'm going to put mine on the screen here. So if you're not sure how to do that, so we can find it because we know the fundamental accounting equation is assets equals liabilities plus equity. So if we know 2 of those 3, we can solve for the 3rd. It's hard for me to do that. And so there's our equity at the beginning and end of the year. Everybody okay with where those numbers came from? Did I do okay? You need to tell me if I have a math error, because for some reason it's hard for me to see this screen. Maybe it's because it looks like I'm getting on low battery on my calculator. Might have to just use my phone. Okay, everybody's good with those? You know where they came from. Okay. So I just want to point out that on the second row, which is labeled as end of year, none of those numbers have dollar signs. You don't need to repeat the dollar sign when there's a dollar sign right above it. You'll see that on our financial statements as well, and I'll point it out again when we see it. It's understood that dollar sign kind of carries down. So that you don't have to repeat, and you shouldn't. It's not appropriate, it's not correct to repeat the dollar sign until you actually take a total. So if you draw that line, that means, okay, now I'm adding these numbers or subtracting these numbers. Once you draw that line, you need to put the dollar sign underneath it because it doesn't carry through that line. On the basis of the preceding data and the following information for the year, determine the net income or loss of each company for the year. I want to show you something that you may have already seen, but I did not deliberately show you. And I'm going to leave the blue there on the screen, so just ignore it for the moment. In Brightspace, under the reference materials, I know I showed you last time, and we talked about these graphics that I had put in here. So there's the accounting equation with normal balances. We'll be looking at that again on Thursday in chapter 2. We'll also be looking at this one, required form for a journal entry, on Thursday. So don't worry about those for right now. But they are in here. I did a whole bunch of cleanup work in Brightspace last week after I realized that things had not necessarily come in the way they ought to have. I fixed some of the links. So this link to Bellevue University, if you're considering Bellevue as a transfer option, you're welcome to watch this video. It's highly likely that sometime during the semester, I will have the representative from Bellevue who's located on this campus. She'll likely come visit us in class and give basically the same presentation. But if you're just really interested in looking for transfer opportunities, I fixed that link. What I wanted to show you today, though, is the reason I'm coming in here right now, is the Chapter 1 folder has a page called Important Information for Chapter 1. And what you see on this page is a lot of what we've already talked about in this chapter. The 4 financial statements, a summary of what's included on those, the fundamental accounting equation, and then this is what's going to be important for us right now for this exercise. And the reason I'm showing you this right now, how to calculate changes in stockholders' equity. We have an equation here. We have an equation here that you should use, can use for this exercise that we're working on right now. You should know anytime we have an equation, if there's just one variable, you can solve for that one missing piece. And basically for this exercise, you're going to be taking what's given and plugging into this equation. So let's go back to our exercise. I just wanted you to see that this is here as a helpful reference. It's in the reference materials in Chapter 1 in Brightspace. So as we think about our stockholders' equity, we think about what makes up that equity. We've already seen the expanded version of the equity. So it includes contributed capital plus retained earnings plus revenues minus expenses minus dividends. That revenues minus expenses is our income. Okay. So we know that there are 2 main parts to equity. There's contributed capital and retained earnings. And either one or both of those could change during the year or during the accounting period. We can see here, looking at what we already have on the screen, we can see that our equity did actually change during the year. It went from $230,000 up to $580,000. So I just put that line there to show that I'm going to do some math. Unfortunately, these are beginning and end, so I can't really show what I'm doing, which is taking the end of the year, 580, and subtracting the beginning of the year, 230. But hopefully you can see that the change in our equity then is $350,000. Our equity increased by $350,000 during the year. Everyone good so far? Makes sense to everybody? Okay. So our equity went up, and that's true for all 4 of these companies, Amber, Blue, Coral, and Daffodil. Their equity went up by $350,000. But the question we're asked is, well, how did it go up? What made it go up? So we already know the kinds of things that can affect that. We have contributed capital. That could go up because we sold more stock, right? So we could sell more stock. The retained earnings could go up because we made money. We had a positive net income. It could go down because we paid out dividends. And it also would go down if we lost money during the year. So those are the 3 things, 3 big events that could affect our equity. We could sell more stock, we could make or lose money, and we could pay out dividends. And those are for now, until Chapter 12, those are the only things we need to worry about that could affect our equity. In Chapter 12, we'll learn some other ones that are much less common. So what happened with Amber Corporation? It says no additional common stock was issued and no dividends were paid. So they just told us 2 of the 3 things that might have happened didn't. So that means the entire change in our equity, $350,000, is because we made money. So Amber had a net income of $350,000. Does that make sense? How about blue? What happened with blue? Well, no additional common stock was issued, but dividends of 60,000 were paid. So dividends, remember I said, represents earnings that we did not keep. They didn't get added to retained earnings because we paid them out. So blue added 350,000 to retained earnings plus another 60,000 they made and did not keep. So blue actually had net income of 350,000 plus 60,000 or 410,000. They made 410,000. They took 60 of it and paid it out to their stockholders as dividends, and they kept the other 350. Make sense? I'm going to remind you, I know I just showed you this formula, but what I'm talking through with you, explaining where the numbers come from, is how I, in an ideal world, that's how I would like you to think about it. But if you're not really to that point yet, you can take this equation right here, plug in what we already know, and find the missing piece, which is going to be the income or loss. Not number 3, the next one, Coral. Additional common stock was issued, but no dividends were paid. So their equity went up by 350,000, but 140,000 of that was contributed capital. So that means only 210,000 was from the income because they didn't pay out any dividends. So for Coral, net income, the full 350 is the change in the equity. Then we subtract the 140 that was for new stock, and that leaves us with 210,000 that was their income. And I saved the best one for last. This one is telling us all 3 things happened. They sold some common stock, and they paid out dividends, and they made money. So try on your own to come up with that number. I'll give you just a minute to do that. And then I'll show you how to find the answer if you didn't get it on your own. So I just copied the formula that I showed you in Brightspace. I condensed it a little bit without changing it. And then I plugged in what we already know. We know the beginning equity was 230,000 because that's what we had calculated at the beginning. We know the ending equity was 580 because again, we calculated that before we started the problem. I plugged in what was told to us. New investments were 140, dividends were 60,000, and then I just solved for this net income. And I came up with $270,000. So ideally, as I said, you could just kind of think it through, see if it makes sense. Do what I think of as the reasonableness check. Does it make sense that they made $270,000? Well, let me think about it. If they made $270,000 and paid out $60,000 in dividends, that means their change to retained earnings was $210,000. If we then add the additional common stock of $140,000, that gets us to the $350,000 that we know was the change from the beginning to the end of the year. So that makes sense. Questions on that exercise or anything we've been doing so far today? All right. So the next exercise is one of the ones that I have already asked you to complete on your own. So hopefully, if you hadn't already done that, it makes a little bit more sense to you now. We're being told these are all balance sheet items and you need to divide them up, we just have to decide, do these appear on the balance sheet, which means, as we already discussed today, that it's one of the permanent accounts, assets, liabilities, contributed capital, or retained earnings. The temporary accounts, revenues and expenses and dividends, would not appear on the balance sheet. So rent expense appears on the income statement, not on the balance sheet. And so that's all you need to do for that one. And I'm going to keep going. And we'll move on to exercise 8. Financial information related to Ebony Interiors for February and March. I don't think I've talked about this yet. I'm actually kind of surprised nobody's asked. So probably 99% of the time in our textbook and in these exercises, rather than giving a year, they'll give a year that has a random letter. This textbook uses Y. Sometimes you might see it as an X. I'm telling you right now, that's not something you would ever see on an actual financial statement. That is something that textbook authors do, I think, to make it feel like the textbook is more up to date. So if this said 2013, you'd be like, what, that's 10 years ago almost, right? So if you put in the Y rather than the third digit in a year, it just makes it more translatable to future editions and previous editions of the textbook. You'll normally hear me, if I'm just reading that, I'll read it as 2023 because that's the closest year, obviously, that has the 20 and then the 3. It's not some weird accounting thing that you would see a Y. It's just a textbook thing, really. So financial information for February and March 2023 is as follows. You can see a bunch of accounts listed there: cash, accounts receivable, supplies, accounts payable, common stock, and retained earnings. And you can see the balance in each of those at the end of February and then at the end of March. We are asked to prepare a balance sheet for Ebony Interiors as of February. So we're using the dollar amounts that appear in this first column, the column to the left. So we already know that a balance sheet is really that fundamental accounting equation with all the detail. So we list our assets and then we total them. We list our liabilities and then total them. We list our equity and total them. The order matters. Within the assets, within the liabilities, within the equity, the order matters. And it tells us here to enter the assets in order of liquidity. So all businesses have 2 main goals. And the main goals are liquidity, which means being able to pay their bills when they come due, being able to pay their employees so they keep coming to work, being able to pay their suppliers so they keep selling them stuff, being able to pay their taxes so they don't get in any kind of legal issues. And so liquidity refers to how close something is to cash so that we can use it to pay our bills. When we talk about a company wanting liquidity, it means they need cash to be able to pay their bills. And so as we're listing assets on the balance sheet, almost always the first one is going to be cash because we list the most liquid one first, and cash has to be our most liquid. Because liquid, I just said, means how close is something to cash. If it's already cash, it's the most liquid asset we have. So almost always, I can almost guarantee you there will not be a time this semester ever that we see a balance sheet where cash is not the first asset listed. Now you will notice that on your company that you choose for your project, when you look at their balance sheet, I can almost guarantee it will not just say cash, but it will say cash and cash equivalent. And in chapter 7, we'll talk about what is a cash equivalent. So what other assets do you see there in this list up here at the top? What other assets do we have? Supplies and accounts receivable. I think I heard people say both. So accounts receivable represents amounts that are due to us. Our customers are going to pay us, hopefully sooner rather than later. Accounts receivable is also a pretty liquid asset. It's pretty close to cash. We can turn it into cash pretty quickly. And the next one, the other one that people said was supplies. Whoops. And so supplies is a little bit less liquid. In fact, it would be difficult for us to turn our supplies into cash at all. Supplies are things that we use to run our business. They're not inventory that we have available for sale. Supplies for JCC would include things like copy paper and Post-it notes and dry erase markers and whatever. So it would be difficult to turn those into cash at all. That being said, they're still pretty liquid in that we expect to use them up pretty quickly. And so if we add those up, $1,150,000. How about our liabilities on that list? Thank you. Accounts payable. So anytime you see that word payable, you should be thinking, oh, that's a liability. We owe someone. We will pay whoever we owe. We'll pay them later. Now you'll notice we only have one liability. Sometimes these templates that we use in the software make it a little easier for us because we already know we're done. There aren't any more lines there. And so liability, the only liability we have is accounts payable. Because there's only one, we don't need to put a separate line that says total liabilities. That's just redundant to have another line and have it say exactly the same number as the previous line. But in the real world, we don't generally have just one liability. And so you would list them all. You would also list liabilities based on basically when they're due or when they're going to pay them. So the ones we're going to pay sooner would be listed earlier, and the ones that are more long-term would be listed later on. And for our equity, as I already told you, until chapter 12, we're only going to have 2 equity accounts, and they always should be written in this order: common stock and retained earnings. So we have our common stock of 200,000. Oh, but it doesn't tell us the balance in retained earnings, and we have to figure that out. Anyone have any ideas how we might find that common stock number? That retained earnings number, the one that's missing. Okay, from? Okay, so I'm going to add one step to that, but what you said is exactly correct. So, and can you tell me your name? Clayton, thank you. So what Clayton recognized is the total assets must be equal to the total liabilities and equity. So I'm just going to plug that number in down there. plug it in for the total liabilities and total equity, total liabilities and equity added together. So we already know that. In addition, we know how much of that is the liability. So we can subtract, and that's what he said, subtract the liabilities, 310,000, from that total assets. And so we take the 1,150,000, subtract 310,000 from that, and we get 840,000 is the total stockholders' equity. And then last step, of that 840,000 total stockholders' equity, we know 200,000 is common stock, so it must be that 640,000 is the retained earnings, right? Okay. And so if you were inclined to make sure that you had done it correctly up to that point, as I've told you a couple times already, there's no limit on the number of times you can use that check my work button. So if you just want to make sure that you've done that correctly before you move on to the March one, you can do that. Okay. Now, I am going to hold off on this next piece just for a moment. We have about 15 minutes left in class time, right? 11:55, right? So I want to just pause here. We'll probably have time to come back to this at the end of class, but I'm going to ask you to do the March part on your own anyway, because it's really a reinforcing of what we just did with February. And then parts B and C are, again, more practice with what we were just doing with the previous exercise when we're told, okay, we can see what the equity accounts were at the beginning of March. At the end of February is the same as the beginning of March, right? And so we can see what changed, and then we're given some information about whether stock was sold and whether dividends were paid. And so you'll be able to answer B and C as more practice with what we just did in that previous exercise. As I said, I'm going to pause on that to make sure we get through the rest of, we have one more exercise to do. So this next exercise is exercise 9. That's one of the ones that I had told you last time I'd have you do on your own. At this point, you should be more familiar with what's on the balance sheet: assets, liabilities, permanent equity, contributed capital, retained earnings, and what's on the income statement: revenues and expenses. And so for each one of these, you just need to choose. It would be on the balance sheet or it would be on the income statement. And then there's a couple questions to answer down at the bottom. But I want to move on and make sure we get through exercise 10, the final exercise for this chapter, before we run out of time. So exercise 10, We Sell Realty was organized as a corporation on August 1st, 2017. They started their company by selling $15,000 worth of common stock. We Sell Realty is owned and operated by Omar Farah, the sole stockholder. The following statements for We Sell Realty were prepared after its first month of operations. So we can see their income statement. Now, as I'm looking at this, I already see something that's a problem. And if you look, if we just scroll down to the bottom, because I always like to know what is it that we're supposed to be doing here. And what we're asked to do is identify the errors contained within these presented financial statements for We Sell Realty. So the kind of things we're looking for are things that are places that they don't belong. So we've been talking about which accounts belong on which financial statements. So we'd be looking at this income statement to say, are all the accounts that are listed on there supposed to be on the income statement? Well, what's supposed to be on there? Revenues and expenses. Seems like what's on there. But what jumped out at me is this. So we already talked about what the date lines should say in the heading to the income statement. statement of stockholders' equity, and the statement of cash flows. All three of them cover a range of dates. They tell us what happened over a period of time. So it's not appropriate. It can't be correct that the date on here says just August 31st. Now I know, because I read it in those first few sentences, that this is just for the month ended, but anyone looking at this income statement would not know that. So the heading, that line that I have highlighted, should say for the month ended August 31st, 2017. Let's take a look at the others. Here we have the statement of stockholders' equity, and it correctly says, well, it kind of correctly gives us a range of dates, but it says it's for the year, not the month. And by the way, it also says 2016. So it does tell us it's a range of dates, but it gives us the wrong range and the wrong dates. So that one's not right either. And finally, here on the balance sheet, we said the balance sheet is, or I said, the balance sheet is the one financial statement that actually is just that snapshot that shows us where are we right now without telling us what has happened or what has changed during the period. And so that one's also not correct, because it should just say August 31st. It should not have this for the month ended piece on there. So which of the financial statements display the correct heading? None. Make sense? Which of the financial statements cover a period of time? And we've already discussed that, so you should be able to answer that. Income statement and the statement of stockholders' equity, but not the balance sheet. Now, something I want to point out here, I can't remember if I said this last week or not. So the fourth financial statement that we discussed, that we reviewed at the beginning of class today, was the statement of cash flows. I'm pretty sure I said this last week. And that statement of cash flows is the fourth in order of preparation. And the reason it's fourth, the reason it's last, is because information from all three of the other financial statements makes its way into the cash flow statement. And so until we know more about the first three, we can't prepare the fourth, the cash flow statement. So we mentioned it, I threw it out here, last week and at the beginning of class today. It exists. If you look ahead in your book, chapter 13 is called the statement of cash flows or something like that, cash flow statement. And that's about all you're going to hear from me about the statement of cash flows until we get to chapter 13, very near the end of the semester. So in this exercise, they show you only three. The reason they don't include is, the one they don't include is the statement of cash flows, and that's what you will see. I don't want you to forget it exists, but it's not included in this question about which covers a period of time. The cash flow statement also covers a period of time. It's not listed here because we're kind of putting it aside until we know a little bit more about the first three financial statements. What is the equation on the balance sheet? Which one of these is correct? I heard someone whisper it. Third one, thank you. Assets equals liabilities plus stockholders' equity is the correct answer. What is the correct net income? So it's telling us that even though it shows a net income here, it's not the right amount. So how do we calculate net income? Revenues minus expenses. Well, if we take 140,000 and subtract 115,000 and change, it can't possibly be only 25,000, exactly 25,000. So how much should that net income be? And I don't know. It's possible they didn't add up the expenses correctly, but I think that's correct. I didn't check it though. Yeah, so that total is correct. Okay, so did you find the right number? Good luck. $24,150. This error, which was just a math error, this error also affects what other account balance? So when we look here, this $25,000 in net income came down here, and got added to retained earnings. And so they added the wrong number to retained earnings. So what should the ending balance in retained earnings be? Rather than 15,000, it should be 14,150. Thank you. And the answer to the question, which of this error also affects what other account balance, it would be the ending equity, because retained earnings becomes part of that equity. What is the correct total for the total assets? So let's see. So what do we have wrong here? We can tell looking at the balance sheet that there's something wrong because our total assets is not equal to our total liabilities and equity, as we know it must be. So there's something wrong. Let's see what we can identify that's wrong. Do we have our accounts in the right place? Yep, supplies should be up there. How about accounts receivable? That should be up there. Is accounts payable an asset? No, it's a liability, so it should be down here. So if we take cash and accounts receivable and supplies and add those all together, we should get our total assets, right? By the way, it's probably not a great sign for this company that their accounts receivable is about 4 times as much as their assets. That's probably a problem. Maybe that their customers aren't paying them in a timely fashion. They're being a little too loose with their credit. So I added them together. If I added correctly, I got 51,500. Is that what anyone else got? Thank you. What is the correct total for the liabilities? Well, we only had one liability. It was accounts payable, 22,350. So we've answered all of the questions. What we have left is preparing the corrected set of financial statements. So we've talked about all the things that were, well, almost all the things that were wrong. I'm going to point out one other thing that was missing. So you should be able to complete these on your own. We've answered all the questions and pointed out all but one of the errors. So I'm going to turn you loose to finish these up on your own. You're welcome, of course, to stay here and finish them up. If you want to finish them up on your own outside of class, you can do that as well. They should be submitted for grading. Hang on one second, please. They should be submitted for grading before the end of the day. And hopefully you'll be able to do that to stay on track. I wanted to point out one other thing that was wrong with this statement of stockholders' equity. First, I didn't point this out, but it should be the name of the company, not the name of the owner of the company. Okay, and the top line there. But second, it says they issued, I think, $15,000 worth of stock. There should be a column here for common stock. And so you see where you recreate this, it does fix the name of the company and it does add the column for common stock. Okay. So you're welcome. Like I said, we have 3 minutes left in class. Don't forget, you still have to finish up the second month in exercise 8, answer those 2 questions and finish up this. If you want to stay here, I will be glad to stay and answer any questions you might have. Otherwise, good luck finish these up and I'll see you on Thursday.